Good call, Doc.
Let's go.
Can everyone see my screen?
Coming up.
Just seeing everybody.
You guys see it now?
Underwriting
301? Okay.
301.
All right. Hey guys. Yeah, Dean's running numbers, but here I am going out 3 weeks in a row now, stepping on the spotlight, just talking about underwriters yet. So today, focusing on returns and then wrapping up with the fundamental principles. Yeah. So if you've we asked you to dive a little deeper on a couple of deals, to take a look at how it is operating and how is the asking price compared to the performance. I also had you guys kind of ponder over the week what the relationship is between the median household income and the rent that the average household can afford in that market, and why that special number 36, which I'll go into a little bit later in the fundamentals portion. So hopefully some of you guys have figured it out on your own, but I'll go over that in a little bit. So a really quick recap of what we went over the last couple of weeks. So the critical documents required for underwriting are a T12, which is the trailing 12 months, or a P&L, profit and loss statement, and a rent roll. A little less importantly, an OM, offering memorandum. You can underwrite without the OM. NOI is the total income, or the effective gross income, minus operating expenses. Operating expenses are any expenses that are required for the day-to-day operations to run the business. These are above the NOI line expenses. And then non-operating expenses are expenses that are not required to run the property, which includes debt service, asset management fee, not to be confused with property management, as we discussed last week, depreciation, and capital expenditures. And then the property value is calculated by the NOI divided by the cap rate, which also goes hand in hand with the value upside, and that's calculated by the increase in NOI divided by the cap rate. So now let's get into that 301 level stuff, which relate to returns. So I've learned a lot of this by joining underwriting masterclasses, and I'm sharing what I've learned with you guys. So the first and foremost is cash flow. So basically it's whether you make money or not. So the first half of this calculations we've already gone over already, which is the NOI equation, which is, you first take your potential rent income, which is your total market rents, and minus vacancies and credit losses. This is your loss to lease, concessions, bad debt, etc. Vacancies and credit losses together give you your economic vacancy. So take your potential rental income minus your economic vacancy, and you get your effective rental income. And that's the actual rent that you've achieved.
Hey, Victor, I'm going to pause you really quick right here. Dub said he couldn't see any screen sharing. Can somebody put in the chat, is Victor's screen being shared? Can you all see it? Okay. All right, Dub, maybe it's on your end. Exit and come back in. It should be good. All right, solid.
Okay,
cool. Sorry for the interruption, bro. We're just keeping you on your toes tonight, Doc.
All right, so then you've got your actual rent that you've achieved. Then you add your other income, that's your laundry, pets, utilities, reimbursements, etc. And then you get your effective gross income, which is the total income that you've achieved. Take out your operating expenses, and then you get your NOI. From there, you take out your annual debt service and any other below the NOI line expenses, and then you get the cash flow on the property level. Any questions on cash flow?
I think we're
Let's
good,
ask
man.
the question. Yeah, let's ask the question like that. Does everybody understand what Victor just explained?
I have a question. So what is you guys' target, like cash on cash?
Well, we can go on to the next. This is just cash flow right now.
Okay.
He'll get there, brother. Good question, though.
So that's actually next. So from there, we move on to what you and your investors make, which is the cash on cash return. So cash on cash return takes that cash flow of the property and you compare it to the total amount of money invested in the property over a certain period of time, which is typically on a yearly basis. So it's calculated by dividing the cash flow by the total amount of equity invested in the property. So say you had a 75% loan to value loan, you had to put up 25% down payment, you have closing costs, maybe you have some capital reserves. So you add all that money that comes out of your and your investor's pocket, and that goes into the deal, and that's the total amount of equity invested.
Net
you
cash flow, right?
I'm sorry.
Net cash flow.
Well, right now we're talking about yeah, so I mean it's your net cash flow. So
Yeah,
you divide the
numerator.
cash flows each year by that total amount that you've invested into the deal to determine what that cash on cash return is for that particular time period. Keep in mind now that this is cash on cash return on a property level. So the cash on cash return that you and your investors will be different depending on how your deal is structured. And deal structuring, that's a topic all on its own. So whether it's a simple joint venture agreement or if you actually have a full syndication with a 80-20 split or 70-30 GPLP split, pref or no pref, that's a totally different topic. So back to Reginald's question here, most investors typically look for at least 5% cash on cash return at the end of year one. If it were like a low B or a high or a class C, they may want a higher return because it's a higher level of risk compared to a class A. Again, this expectation may change, in my opinion, depending on where interest rates are going, because if interest rates keep going up, that means the interest rates from your bank savings accounts and CDs, those are going up too. I actually just checked my Ally savings account and my interest rate has gone up to 3%, which it has not been 3% over the last couple of years.
Did you say 15%?
I'm sorry?
Did you say 15%?
What 15% what?
Oh, all right. Sorry. I thought you had actually said the cash on cash. Sorry.
No. So
3% on his personal Ally savings account.
yeah. So if interest rates keep going up, that amount of cash on cash return from investors that investors want to expect, that may go up to. That's my opinion, because otherwise they might as well just put that money in a bank and put it in the bank and get a better return. So kind of you have to keep that kind of in mind. Also, syndicators may also give investors a preferred return or a pref. Sometimes it can go around 6 to 8%. So a preferred return is when you've basically promised the investor a certain amount of return before you as the general partner can receive a profit. So if you're offering an 8% preferred return, that means say they in total you have $100,000 invested and the deal only produced 7,000 at the end of the year. That's a 7% cash on cash return. That means the investors did not get all their return. So you as a GP, you don't get anything. And that $1,000 that's still owed to them, that's still owed to them. And now that gets tacked onto their account. If the cash on cash return is more than that agreed upon preferred return for your investors, then you can get paid with the overflow, depending on how you've structured the deal. So long story short, cash on cash return is simply the amount of money that you get at the end of the year divided by the amount invested in the deal. And that gives you your cash on cash return.
And bro, one question. I think Kim asked on the previous slide, credit loss. Can you quickly explain?
Credit loss, that's rent concessions, that's bad debt. Yeah, so stuff that is a rent loss. So basically rent loss.
Got it. All right, guys, was that clear on the next slide or with the cash on cash? Understood? Yay, nay, yay, nay. All right, I don't see any nays, so we should be good to move forward.
Okay. So next is equity multiple. So your equity multiple gives you the total return on your initial investment. So basically, how much did your money turn into after the entire business plan is carried out to completion? You calculate that by taking the total dollars received divided by the total dollars invested. So that's all that cash on cash returns plus the returns you made on the sale of the property at the end. You add all that together and divide that by the total amount invested, and that will get you your equity multiple. So for example, a 2.5%, 2.5x equity multiple means for every dollar you invested, after the property gets sold, you would have gotten back a total of $2.50, which includes your initial $1 investment over the entire holding period. You definitely want that equity multiple to be greater than 1, which means you're getting back more money than you invested. So your equity multiple is a way for your investors to compare different investment opportunities. But the drawback of this metric is that equity multiple does not account for the factor of time. So you can have 2 deals with the same 2.5x equity multiple, but one might get those returns over 2 years, and then the other one over a 10-year period. I mean, in both cases, the equity multiple is the same, but obviously you would have, you probably would prefer to have your returns faster in that 2-year hold. So as an investor, you shouldn't use equity multiple to gauge the returns on an investment without first considering the hold period. So because of this, there's no real good equity multiple because it depends on the investor's goals. When comparing different deals, they may be willing to accept a lower equity multiple if the returns are made sooner.
And Victor, quick comment from my end. A lot of other teams, or what I've seen on PPMs, is they like to advertise the asset equity multiple. What's the difference there? Because I think it's important for everyone to understand the difference between the investor equity multiple versus the asset equity multiple.
I'm not sure by what that means. If you want to answer that, if you know what that is.
So I mean, if you look at equity multiple, you can look at it 2 ways, right? You can look at it, what is the return just on the LP side in terms of equity multiple? Meaning if you put 100K in and you have a 2x return, your 100K should turn into 200K. But one can also just share the overall equity multiple, meaning the overall equity return for the entire asset, which puts together the LP side, limited partner side, and the GP side, the general partner side. But that can be a little bit misleading because that could be like a 2x, but that doesn't mean then that 100K of yours would turn to 200K, would turn actually into a little bit less because it puts the GP shares in there. So that's just something, when you only see equity multiple, I would always encourage, just ask, how is the equity multiple being calculated? Is it the asset equity multiple or is it the investor only equity multiple?
That's a good point, because if it's just a syndication, you have a GP LP, you have a split. Obviously, all the cash. If there's no, let's say there's no preferred returns, you have all the cash flows and then all of the returns on sale, or if there's any proceeds from a refi, you have that split. So if your GP didn't put any money in it, they have no initial investment. All of it's coming from investors. So all the cash flows could be split depending on how the deal is. So so the deal, like you said, the asset equity multiple can be different than what the equity multiple is for an LP. Typically, it'll be a little bit lower.
You know what a good way to think about what you guys are trying to explain is a good way to think about it is that there's how much money you personally had to come up with to put in it. There's how much money in general had to be come up with to buy it. And then there is each individual investor, or if you want to separate the GP and the LP as 2 groups, how did that money that they contributed calculate into the return? And so it's just a question of, is it the thing you're buying? Is it you personally, your money? Is it the money? Or is it each investor's money? Or is it their collective money? That's all that you guys are trying to explain, it seems.
Yeah. So, I mean, when you are, let's say if you're pitching a deal, you can, that might be something that you want to clarify. You can say that the property level equity multiple is this much. But as an investor, this is what your equity multiple will be. And that's on you as a GP when you're presenting when you're pitching to make that clear. All right, so I guess I can move on to the next one. So now, so to overcome that time factor that equity multiple doesn't account for, investors will use a different metric that's known as the internal rate of return, or IRR. So the IRR is the rate of return that each dollar in an investment earns while it's still in the investment. So what makes this metric different is that it accounts for the time value of money by assuming that a dollar is more valuable today than it is in the future. Main factor, being due to inflation. And that's a way to discount the earnings that you receive in the future. So the further into the future those earnings are, the less valuable they become. There's a complicated formula that I'm not going to go over, but essentially the IRR is essentially the percentage of interest that you earn on every dollar that you've invested in a property over the entire holding period. A good IRR is between 15 to 20%. I don't want to cause any confusion when I say this, but usually you aim for a higher IRR when you compare investments. However, this doesn't necessarily mean more return. So we can use equity multiple and IRR to compare deals side by side, especially if they have the same hold period. A higher IRR typically means that there's higher cash flow, which means that you'll recoup your invested dollars sooner. But that doesn't necessarily mean it's a better investment than another deal with a lower IRR projection, because that one may achieve higher return or equity multiple. So if you look at these two examples I have here, in property A, you have a higher IRR at 14.9%. But property B has a higher equity multiple at 1 point. Oh, this should be X. Sorry, the equity multiple should be X, not percent. That the property B has a 1.8x equity of 1.8x versus 1.65x from property A. I guess we can hear from you guys. Why don't you guys put in the chat which one of these would you rather invest in? Keep in mind, everybody has different investment goals or different expectations of an investment. So I'm interested to hear which one you guys are interested in investing.
Victor, I got a question on this actually.
Sure.
So if I'm an investor and I'm coming in and I only want to be an LP for 1 year, as in I want cashed out in a year versus other LPs, is there a differential between LPs? Can different LPs be in for different amounts of time?
That depends on the deal structure. That has to be decided up front.
Okay.
You
Now
can't
with
have different,
that,
you can't have different investors have, exit at different times. That has to be agreed up front. You may have different stacks, different groups of investors in different time periods. So you may have like it gets really complicated. You may have a very small pref group, people that get a pref, they get paid out first, and then any overflow goes on to non-pref investors. But it's a very complicated thing. But that has to be
Okay.
agreed upon, the deal structure upfront.
okay, so in that case, you're saying a group of LPs could be cashed out year one, and then the same deal that was funded by another group of LPs could be cashed out in year 5?
That all depends on the deal structure. Now, if they want to get cashed out, that better be known in the deal structure in the PPM. And typically, if they want to get cashed out, they probably would have a pref. And then when they get
Okay.
cashed out, the GPs, the GPs or however they decide, those shares get distributed. They cash out, they're out of the deal.
Okay, thank you for that. And then that kind of leads into my second question here. Why would a property cash flow $1.5 million in the first year?
These are just examples of IRR and equity
Okay.
multiple. This
Okay,
might,
these aren't actual underwritten deals.
these are not actual underwritten deals.
Okay. Okay.
Obviously these are very different, polar opposites, but I'm just trying to show IRR is just a calculation. And then same with equity multiple. This is just how the math works. You may have
Thank
an IRR that's higher, but it has a lower equity multiple than another deal that has a lower IRR but a higher equity multiple.
There's some other benefits, right? Like cash up front, like what if you have to pay something off quick? The one on the left is good,
Mhm.
and then if you look at present values, that could change your mind.
Yeah. So between property A and property B, there's no right answer which one is better because it really depends on your goals and objectives. I mean, in hindsight, if you knew that it's going to be a 5-year hold, property B would be a higher return. But as you go year on year, you don't know what returns are. So some investors would rather earn their distributions sooner and so they may choose to invest in property A, which has a slightly lower overall return, but those returns are earned earlier in the hold period. An investor that's less concerned about the timing of their earnings, they may be fine investing in property B, which has a slightly higher overall return. So generally speaking, for cash flowing properties, a higher IRR typically translates to a better investment opportunity because it's performing better. Does that make sense?
So which one did you invest in, Victor?
It depends on your risk. If you and how they pitched it. If you knew that you wanted to get you wanted to invest something but needed to get it out sooner, then maybe A is good. Then A is good because if you invested 4 million and then year one you would have gotten back out what percentage of this? I don't even know how many percent of this. A significant amount of it back year one, and you can put it into another investment. Then maybe that's your plan, and that's good for you. But if it's like a long-term hold, and you really don't care how the money gets paid out. If it's like play money for you, and you know that the equity multiple is higher, then maybe property B.
10-4. We had a combination of A's and B's. I'm on the A side.
A is typically more a safer, I guess, investment because you know that you'll be getting more of your money back a lot sooner than deal B.
Thanks, bro.
I'd love to ask everybody, does this make sense? If it makes sense, please put a yes in there. If in the chat, if it doesn't, put a no, and then we'll see that we re-explain this. And I explain this one more time because it's really important that this is understood. This is one of the main things that's really important. Okay. Amazing. You're a great teacher there, it seems, Victor.
Okay.
Let's go.
So that's what I have for returns.
Oh, hold on, Victor. One question. Like Sean says no. Let's do this. Sean, are you able to unmute yourself? I would love to hear because we don't want to leave anybody hanging. What is it that's not really clear?
This is my first time, so I'm perfectly fine with like maybe even sending Victor the question after this. But I guess I just don't understand like what the return is and how it's being paid out. That's the portion that I don't understand.
I think that actually might be more part of deal structuring. And that's kind of out of scope for today. I'm just going over the underlying principles of returns, which is the cash on cash, cash flow, equity multiple, and IRR.
Here's what we're gonna do, Sean. Throw that question into our Facebook group, okay? Like, just do a post and we'll make sure it gets answered. Let's go, brother.
Okay. So that's kind of it for returns. So I kind of want to go back and tie everything together and kind of, oh wait, I forgot. I do have some examples for calculating returns. So let's do this. The first one is a cash on cash return. If you have $1 million purchase and the initial investment is 300K, if you have 15K year one cash flow, 18K year two cash flow, 21K year three cash flow, and then you sell for 1.5 million at the end of year three, what is the cash on cash return for each year?
So with the with the cash on cash, are you counting the sale in that equation as well, or just the cash flow?
Well, cash on cash return is the cash flow divided by the initial investment. Okay, so for year one, it's you have 15K year one cash flow. You divide that by the initial investment of 300K and you have 5% year one. Do that again for year two with 18K, that's 6%. And then year three, the cash flow is 7%.
I see that Trevor was the fastest in the chat to put that in there. Boo, bro, you're supposed to be front office.
Can I get a one-on-one with you guys now? Let's go.
Let's go.
Let's go.
But this shows again, right, for everybody that Trevor can do this too. Although he's sitting in he's not doing the underwriting, right? Trevor is doing all underwriting on the team, but yet he's capable of doing that as well, which is important.
Okay. So this is now keep in mind, this is property level cash on cash return. So let's do this if you have a syndication. If you have an 80-20 equity split, 80% goes to the limited partners, your investors. Same deal here with the same purchase and cash flows. What would be the cash on cash return for each year for your investors? So if you basically you do the same thing, but you multiply everything by 80%, because that's the split that your investors get. So your year one will be your 15K times 80% divided by 300K. That's 4%. Next one is 4.8%. And next one is 5.6%. So I just kind of want to do something where you see what the difference is between the property level and what the investors get. So going back to this, if you're looking at the property level, year one would have been 5%, but your investors would have gotten only 4%. Year two, property was 6%, investors 4.8%. And year three, property was 7%, investors only 5.6%. So that gives you that comparison between what the property level is and what your investors get. And keep in mind, this is a very simple 80-20 split, no pref. So this is just a very simple example. So it seems like everyone kind of got that. So we can move on to equity multiple. So use the same calculation, same numbers. What is the equity multiple on a property level?
Victor, you don't count the sale as the cash flow. Is that by
Sale
definition?
does not count as cash flow. I don't count that as cash flow. That counts as a that's on a sale. So that I normally count that separately.
So on a sale, Victor, on a sale, like, so if you have an 80% equity split with your partners on that one, your partners would have had a 1.2% return, right? Or a 1.2x, sorry.
I'm sorry, what was that?
When you sell this property after year 3, your
Mhm.
partners had a 1.2x on their investment, correct?
I mean,
Selling at 1.5,
Mm-hmm.
80% of 1.5 is 1.2.
No, because did you count in all of the cash flows
I did
throughout
not
the
count in
year?
all the cash flows, so you're counting that in.
For equity multiple? Yes, because
Okay, thank you.
equity multiple is whatever money you put in. What is the total amount of money throughout the entire holding period you got out?
Okay. All right. Thank you for the clarification. I was just thinking that the equity multiple was on the sale, but you're adding all cash flow and everything. Gotcha.
Yes. So in this example here, this is no investors. This is on a property level. So the first thing you want to calculate is the profit on the sale. So you sold it for 1.5 million, you bought it for 1 million. So the profit was 500K. Then you want to add up all the cash flows and the sale, divide that by the initial investment, and that equals a 1.48x equity multiple on a
Right,
property.
that's what I was asking. That's what I was asking. And we're putting all the earnings together. Yeah, as an
Yes.
investment. Yeah.
Did that make sense?
Let's give some more yeses in the chat or nos, because I do see some people putting a different number there. Maybe it's just a flip in the numbers. All right, I see yeses. Awesome. No nos. But don't be discouraged to put a no there, guys, right? We want to make sure no one gets left behind. If there is a no, we'll address it. No nos. Let's go, Victor.
Okay, so
stuff.
we can do the same thing, but on your investor side. So same thing, same numbers, except you have an 80-20 split.
Victor, again, equity multiple is the profit and the sale,
Mm-hmm.
and
So-
compared to the IRR.
No, you're doing equity multiple. You're adding all the profits. So that's the profit on the sale and all the cash flows throughout. But you have to remember, if you have an 80-20 split, everything is split. They don't get the entire thing.
So you took the profit, which is what it sold for minus what you paid for it.
Yep.
Looked at the cash flows. You added them up. You just added all the cash flows plus the sale, all potential income.
Yes, that's
And-
equity multiple.
Right, but then
So-
you took all that and you added it to the profit, right? The 500 profit.
Yes, because that's all the money you've made.
I got it. Okay, and then that whole thing is compared to what? Again, I'm sorry, one more time.
The initial investment.
Initial investment. Okay.
So again, your profit on the sale, you had 500K, but since you had a 80-20 split, all the cash flows and all the profits was split 80-20 with the investors and the investors and the GP. So you added all the cash flows, all the profits, you had split it 80-20, divided by the by the total initial investment. And so you have a 1.48 equity multiple.
Cha-ching, got it. Good job.
So it sounds like everybody got this one now. Okay. So now that we've kind of gone full circle, kind of wanted to go back to the fundamentals of when you want to look at when you're underwriting properties. So again, the two documents that you're going to need in order to underwrite the deal is the rent roll and the T12. Do not rely on what the OM says, what the financials that they have in the OM. A lot of the times the OM has outdated data compared to what the current financials are. They write OMs a long time before they put it onto the market. So sometimes even if they put it right on the market, I've seen OMs be showing like 3-month-old data on the OM compared to a current T12 and rent roll. So don't rely on what the OM has. Always take that T12 and rent roll and underwrite it yourself. Then
I have a question. I'm sorry.
sure.
So wait, your equity multiple and the equity multiple with the investors, they both came out to 1.48 times.
Oh, I did not
Am I-
multiply that by 80%.
Yeah.
That is my bad. I did not add that to I did not update the slide. I am so sorry.
I love it. That means we have a lot of high level people in here. Get great stuff, man. Look at that.
I think
So
we can
that's
cut you a little slack this time, Victor. A
That's
little
the
slack.
1477. That's the 1477 that everyone was getting.
Victor, let me ask you real quick. So yeah, I know that sometimes the OM and all that it's old, but sometimes also the T12 may be old. So at what point do you run these numbers using T3s instead? Like you asked for a recent T3 if the T12 is already old.
So a T3 would be needed when you really look at a T12. You really want to look at a T12 because that's the performance of the property for a year. That's what you care about. Now, when you are underwriting a lender, or especially if it's an agency loan, they will look at a T3 income. They'll look at the T3 income, but that's it for T3. Then they'll look at the expenses that was on the T12. So you don't want to underwrite based off of a T3 because you don't see the entire, performance of the year.
All right, so you wouldn't try to project those T3s. So because I'm thinking, actually, let me clarify my thought process here. I'm thinking of a property that may be in flux, where that T12 may have been on income based on units that were not renovated yet, yada, yada. But now the T3 may be offering, hey, these units were renovated and we're able to get this income. Now the income has been updated. And so you can make projections based off on this, assuming that no new units are renovated. And then it's you who does, you can do those numbers after that. So you can do that perform after that.
You're projecting, and then you're doing the work. Then you're doing the work to do the rest of it to be at that value. You know what I'm saying?
So even though he's already,
then that's almost like buying on pro forma.
right, but what I'm saying is, even though he's already getting those new rents on those few units for the last 2 or 3 months, you will still not take those into consideration on your initial underwriting. You will leave that to the lender stage of that process.
I would, on a more conservative side, yes, that's what you would do.
Okay.
That's what you would do.
All right. Thank you for that clarification.
You can do, if you really want to, you may be able to do that for the income, but I would not do would not extrapolate T3 expenses to.
Oh, I see what you mean. Yeah, and that's perfectly clear. Yeah.
Mhm.
Yeah, the expenses I will not touch. I'm just talking about, hey, I've been getting this income for 3 months. Here's the proof, right? So here's a check
The
from this.
income, then maybe, then
Oh, okay,
maybe, then maybe, because then that's
Okay.
proven that's what they have been getting.
Mhm.
But also keep in mind, they may
Yes.
it could have been some extra stuff that they were doing for those.
Yeah, some manipulation and whatever.
Yeah.
I get it. Yeah, and
Yeah.
some things that they may be putting on one up
Exactly.
or down and just kind of like, yeah.
Yeah.
So you
And
need to,
brokers will try to sell you on that too. And they
I get
absolutely
it.
love selling on T1, T3,
Yeah.
because they might have just implemented something just for a little bit to show that they've proven increase.
I
But
see what
they
you
may
mean.
not, be sustainable.
Yeah, this may be multi-month rents, they're not leases necessarily. So
Yep.
that's another problem. So that's something we can blame Felix for.
But yeah, I would absolutely not I would not extrapolate the expenses from a T3 for
Yeah,
12 years. For
Yeah,
12 months.
that's granted. Thank you so much for that clarification. Yeah.
So yeah, I am so sorry for this mishap here. The equity multiple for the property was 1.84, and then for the investors was 1.48.
Will you guys be sharing
47.
that pitch deck at some point? I've been listening to the whole thing and watching you guys, but for some reason I never was able to watch any of the presentation. Are you able to do that for me, Victor, at some point?
The pitch deck?
Yeah, that what you have there presenting, because I haven't been able to see what you have.
You mean our presentation?
Yeah.
We'll discuss this as a group, how we
Okay.
want to do this, because mine is a really big presentation here.
Oh, no, I was talking about today's, but okay, thank you.
Yeah, I
We'll-
mean, the
we'll- we'll
recording will
discuss.
definitely be available, Dubs. The recording will be available for sure, and it will show all the slides.
Oh, perfect. Yes, thank you.
100%.
And Victor, what's amazing is, I mean, although there was the not a mishap, I don't call it, but in the chats when people were doing the calculation, that means they were doing it right actually the first time. So
Yeah.
great job, everybody.
They were catching you, Victor.
There you go. All right.
All right. So going back to these fundamentals, so you have just do your due diligence and use the rent roll and T12. Don't rely on the financials on the OM. So after you get the T12 and rent roll, you want to do a market analysis to verify your projections, your assumptions in your underwriting, like rent growth or rent decline or market occupancy or what your market rent concession is. And then you want to underwrite to year one cash flow for your offer, not to the end of your business plan. So your lenders will underwrite to year one to determine what the DSCR is, how much that they will loan for you. They're not going to look at your pro forma 5 years down the line to tell you how much they'll lend to you. They'll underwrite to year one. So in this debt market, you should try to get long-term debt, meaning fixed rate for 5, 7, 10 years, not short-term bridge debt loan. So we really want to try to get 75% LTV. If you cannot get 75% LTV or loan to value, then that means your cash flow year one did not make the minimum DSCR. So there is a chance that you've overvalued the asset and you're going to overpay. So over the last several years when interest rates were really low, there were investors that were getting short-term bridge debt with floating rates so that they can get interest-only periods and then refining out. If you get short-term debt now, you're probably not going to survive what's going on in the market with the rising interest rates and just the fluctuation. Then the property should be, if you're going to buy a property, you should buy a property that's cash flowing day one. We're not buying for appreciation, which is how investors were able to get away with buying on pro forma. In this market, that's not going to happen anymore. We have to buy for cash flow. The first rule of investing is to never lose money. Rule number 2, never forget rule number 1. So don't buy a property if it doesn't cash flow. So it must be cash flowing.
So no vacant buildings.
That's not a stabilized property, and you are not going to make money day one. So again, we're not buying on appreciation. It must be cash flowing day one. And then going in cap rate must be above interest rate. I touched on this a little briefly the other week. The more technical answer is if you have an interest rate that's higher on your loan than your going in cap rate, you have what's called negative leverage. That means if you have paid cash for the property, you would have gotten a higher return rate of return than getting debt. That's opposite of what we want to do. Normally you get debt so that you can get a higher rate of return. That's why you hear when interest rates go up, cap rates must go up too. That's because investors, we want to keep that leverage. So if we don't, and we go the opposite direction and we get into negative leverage, you're going to get less and less return based on the loan amount you get for the property. Did all this make sense?
Yeah, I just have a question on that last bit there on the cap rate.
Mm-hmm.
So if you're liquid in cash to be able to put down on a multifamily property here, would you put enough cash down in order for your loan to be underneath your cap rate? You understand what I'm asking there?
I'm not understanding your question because
Victor,
cap
I know what
rate
he
is.
means. I know what he means. And Tyler, the problem becomes this: at some point when you put too much down, that means you have a lot of investment in the deal, and that way you dilute your returns, right?
Yeah, and
you have
that's
to-
Oh,
you
you
have to
mean
pay
that's
more
what I was
you
money.
mean to meet the DSCR, not the cap rate. Yeah.
Well,
So yeah, at a certain point, you can play around with the returns depending on how much down payment you have. At a certain point with any kind of interest rate, there's a point of, there's a point of no return where the more you put in, you actually get less, you get less returns. But yeah, in this situation here, if your going in cap rate is lower than your interest rate, you would have you're better off you're getting better returns if you just paid cash for it, all just paid all cash for it. So I know Charles, you might be able. Uh-oh.
you're good.
I
You
guess
just
my
cut out for a
question-
second.
Victor, you touched the microphone and you disconnected something there.
Yeah, can you guys hear me now?
Now, yeah.
Okay. Yeah, Charles
I
might
heard
be
you
able to
hollering at me,
touch on.
Victor. What were you saying?
Charles might be able to touch on this. I know Grant Cardone, with all this interest rate now, sometimes he's just buying straight out cash right now, right? To ride out the recession and all these interest
Yeah.
rates.
Yeah, I think well, I know his most recent purchase in Arizona. I mean, he did it all cash, and that way he can control the debt as of right now. And when he gets more favorable terms on debt, he'll refinance it. But I mean, I don't have 70 million to just put it into a deal like him. But
When you mean cash, are you talking about investors' cash, or are you talking about like
yes,
like, oh god, dang, well,
Yeah, he's sitting on like 300 or 400 million dollars, so he could have done that easy. Yeah.
yeah.
So yeah,
I mean,
in this-
you guys
in
worth
this-
billions.
In this interest rate market, yeah, if some people, they may just buy it straight cash because returns are going to be better, depending on where they're buying at, than if they were to get debt.
Yeah, and just if we could real quick, like I guess the reason I asked that question was because if I'm thinking of like somebody who's 1031 trying to 1031 into a new investment property, would they rather come out of pocket more to lay more on the down payment than lose it to taxes, So that's kind of where my mind was going with that is if the cap rate is lower than the interest rate on the loan, on the DSCR loan that you're getting, would it make sense to find somebody who's 1031ing who is maybe in the 4th or 5th month that absolutely needs to deploy capital that is willing to kind of overpay into the deal. I mean, I'm just, this is just
It all
theoretical,
depends
I
on,
guess.
it all depends on the investor's goal and the performance of the property. So your going in cap rate might be below the interest rate year one. But if it's, you project and you can come in and really add a lot of value, starting year two, maybe year three, you would be higher, you'll get more returns. But in year one, if you go in year one, you will be less returns than if you were to buy it straight up cash. And
I think
it all
that's more
depends
of
on the
a-
property.
Thank you.
Yeah, I think that's more of a risk management question.
But it's a good point with the 1031 exchange that you bring up, Tyler, because when Trevor and I speak to brokers at times, that can change the buyer, right? Some say, well, we're looking for some 1031 whatever buyers, and we say, well, then that's not us, right? If you firm on that price, whatever that cap rate, then you look for a different buyer. So it's a valid point that you're bringing, but it's something you as a regular investor or us syndicator, whatever, can compete with.
Hey, Victor.
Hey,
Hey, question. So you're saying going in cap rate, just clarify for me, are we talking about the asking cap rate or the market cap rate?
so the going in cap rate would be the going in NOI divided by the asking price. That's your cap rate. That's your going in cap rate.
Got it. Okay, thank you.
Victor, let's answer Aldo's question real quick. He's had his hand raised for a minute.
Yeah, thanks.
Um,
Hey, can you hear me okay?
Yep.
Awesome. Hey, just like to see if you can go back to the 75% loan to value concept a little bit better or a little bit more. I had not heard of that, so it seemed interesting to me.
So yeah, 75% LTV, that's kind of been what the standard was before everything has gone crazy. And if you can get a 75% LTV, that means you've reached your year one cash flow meets the minimum DSCR that the lender requires. So if they won't approve a 75% LTV loan, that means your year one cash flow does not meet the DSCR. And then that's why then they'll come down to 60, 55% LTV. So if you're going around trying to get debt and then they're only able to give you 55, 60% LTV, that means your cash flow in your underwriting or their underwriting isn't meeting DSCR, meaning you may. So this is kind of like a benchmark or a stress test that you can have to determine if your purchase price or asking price is about right.
So then this would inform your need for raising capital for the equity.
Raising capital and whether you may be overpaying or not.
Right. Okay. Makes sense. Thank you.
All right, guys, quick comment. We will have to finish at 10 after 10. We got 8 more minutes. Matter of fact, if you have important questions, throw them in the chat so we can see that we can answer them in the chats on the side. Trevor, Charles, myself. Unless we don't know the answer, we get Victor. But Victor, let's crush through the content. As you guys know, always an hour and a half only. That's why we want to be efficient. So let's run through. We got another 8 minutes, and then we gotta let everybody go for tonight.
Okay. So what are the assumptions that we are making when we are underwriting? So the first one, your projected rents. These are the rents that the broker tells you that you can get after purchasing the asset. Just don't believe what's on the OM or what the broker tells you. Do a market analysis that can show you what your projected rents are for your neighborhood compared to direct competition in the area. Verify that comps that your broker provides you are truly comps. Are they in the same neighborhood and are they direct competitors to your property? If your property is in a tertiary market and their comp is all the way near downtown, that's not a comp. Next one, total economic vacancy. So you may have a property that's 100% occupied on your rent roll, but that's only for that particular moment at that particular month. And right now, that market may be at 97%. But you have to look at the long-term occupancy average of that market. It may be somewhere around 93% long-term occupancy average. So that's why doing the market analysis is so important. The lender is going to underwrite at least 5% physical vacancy. Then they're going to tack on credit losses, which is typically around 2 to 3%. So you're going to end up with between 7 to 10% economic vacancies on the lender's underwriting, and that will impact your loan to value and your DSCR. Next one, your income growth and your expense growth. Conservative underwriting would be to have them be equal. So your income growth and expense growth will rise at the same amount. Same amount. So that means year on year, assuming your property is stabilized, your income will increase, say 3%, and your expenses will also increase by 3%. Your rents are going to increase steadily, but your expenses like taxes and insurance are also going to increase. What you can't do is say that your income growth is going to be 10%, because the market showed that it was 20% in 2021, and you're only saying you're going to increase it by 10%, calling yourself conservative, but then only say expenses are only going to increase by 2%. What's that going to do to your model? Your projections are your income's going to go shoo, and that's not realistic. So you really don't know what rents and expenses are going to be in the next year, in the next 3 years, in the next 5 years from now. Real conservative will be to just make them equal. That's conservative underwriting. And then back to that 75% LTV question there. Yeah, loan and refinance interest rates and loan to value. You can test your purchase price against the loan to value based on the interest rates. So if your lender will only give you a 55% LTV, that means you probably have a problem with your DSCR. We have to look at that interest rate, because if your going in cap rate is 5% and our interest rate is 7%, you're now in negative leverage. So if you can meet DSCR at 75% LTV, you've probably done good on your underwriting, and you add a pretty good purchase price. And then the last one is your exit cap rate, and which is the cap rate you think that it will be at the end of your business plan when you sell. And that's going to determine your property value based on your projected NOI. So this exit cap rate is also a driver of the IRR. If you change the exit cap rate by just a little bit, even 0.1%, 0.2%, that can change the value of the property by a lot. So do not manipulate the exit cap rate on your model. A lot of investors will play around with the exit cap rate to make the return, to play around with it to make the returns for your investors. So you have to understand where loan interest rates are right now, and interest rates are going up. So I've been hearing experts saying that interest rates are going to continue to go up to double digits. They may not be in double digits for very long, but then it's going to stabilize at long-term rates, which historically has been on average been around 6 to 8%. We're not going to go back down to 3% rates anytime soon. It's going to eventually go back to long-term rates. So it's going to be that 6 to 8%. So be a little conservative what you think the interest rate is going to be 5 years from now. It's a guess regardless, but at least you're using data to get there. Where you think interest rates are going is where cap rates are going. So you can't say that interest rates are going to be at 6% at exit, but then you manipulate your exit cap rate to be at 4% to meet the promised returns for your investors. So there are stress tests that you can do for these assumptions. So you can test your projected rents by checking the median household income in the area. This was part of the homework. The relationship between median household income and rents. So if you've ever rented before, during the screening process, they typically ask you for pay stubs. Why? To make sure that you can make enough money to pay the rent. So how much do they want you to make per month as an income requirement, that's typically 3 times the monthly rent. So property manager would typically set an income qualification to make sure that the tenant can afford rent, and they want to see that gross income for the month to be 3 times the rent. So what does that median household income represent? It just means that half the households in the market are below that income level, and the other half are above. So that's right in the middle, where you would expect your typical renting household would be making. So how do you determine the rent that the typical household can afford? You take that median household income, that's for the year, divide that by 12 months, and then to get how much it is per month, and you divide that by 3, and that should be your market rent for your median household income. So just keep in mind, this median means half is above, half is below. So take that as you will. So, so if you have, say, like a 300 unit property, there's 10,000 units on the market, and 20% of your units have a $500 rent bump increase. That's part of your business plan. But the remaining units are not yet done. You really want to think about that median household income before you bump the rest of the units to see if your market can afford the rents. So your median household income is a test for your underwriting for your projected rents. Next is the operating expense ratio. Again, even the best property management companies for brand new built Class A properties, the best that they can do is 35%. And that's going to be 45 to 55% for older Class B and Class C properties. This won't apply for high rent markets like California, New York City, Miami, where rents are sky high. It also won't apply to smaller properties for like 2 to 20 units because you don't have the economies of scale that drive up expenses. So operating expense ratio is another test for your underwriting. And again, the last is your loan, the DSCR versus LTV. If your lender can approve you for a 75% LTV, you probably did well on your underwriting. And then the last one is break-even occupancy. The break-even occupancy is basically the occupancy rate needed to break even or to start making a profit, depending on if you're a cup half empty or a cup half full person. So that's the sum of all the operating expenses and the debt service, and you divide that by your potential rent income. That gives you your break-even occupancy ratio. So typically, the lower the break-even occupancy ratio, the better and less risky the investment is. So for example, if you have a 100-unit property and the break-even point is 95%, that means your property has to be 95% occupied for income to cover all your operating expenses and your loan payments. That gives you a very small margin of error. So having just 5 units empty, that will cause your property to be cash flow negative. Most break-even occupancies fall between 60 to 80%. So if you're at break-even occupancy, you have a DSCR of 1.0. So just be careful of this because typically there's a clause in the loan that states if your DSCR drops below the minimum, the lender can call the loan due or make you pay down the principal to meet that DSCR. So I went over that real fast. Are there any questions? I think Dubs, you have your hand up. You have another question?
Doesn't
Guess
look
not.
like it. Victor, I'm thinking go into the homework, and then I have a thought on questions and everything that we can discuss after you shared the homeworks, so that we get to that, and then we close it out.
So homework, we always like to leave you with some homework and some action items. Since you guys have dug into a couple of deals over the last 2 weeks, continue doing that with the deals that you've been diving into. Ask the broker for a debt quote so that you can calculate your cash flows based off of what loan payments would be. What is the loan to value of the whisper or the asking price? How does the interest rate that's on your debt quote compare to your going in cap rate? What is your break-even occupancy? And then assuming if your initial investment is just down payment, no closing costs or capital reserves, what would be your year one cash on cash return on a property level? And then what is your year one cash on cash return for investors, assuming it's an 80-20 split with no pref?
Awesome. And then just for everyone to understand, this is exactly what we went through, right? Like when we started this journey, week by week, we did exactly that, step by step, just continuously grew and just answered these questions, right? Dove into the deals, and heck, one deal worked out, great, right? But you got to dive into a lot of deals to do this, and you become more and more confident about it. And I mean, heck, it took Victor only 4 months to speak in front of 100 people without being nervous whatsoever and being asked questions about numbers, and where the majority of us would start sweating, and he's just whooping it left and right. Incredible. But you all can get there. Absolutely. Just by consistent action week by week. And I'm thinking, Victor, since we also had to go through this real fast, and considering that we had this whole sequence the last 3 weeks, these 3 parts, where I would encourage everybody also to look at these. If you haven't seen all of the underwriting videos, 101 and 201, to go back at it and take a look at it. And what's the appetite for next week here, guys? If we were, and Victor and Trevor and Charles, let me know your thoughts too. What's the appetite to do a simple Q&A on everything? We just open the floor and everybody can answer or can ask any kind of question, specifically, obviously, to underwriting. Feel free to dump other stuff in there too, of course. But how much value would that be to you guys, instead of us running through something next week? More so, obviously, have that on hand, our whole deck in regards to underwriting. But for you guys, prep some questions over the week that you come across, and then just fire away the whole Zoom, with question. What would be the appetite there, guys? Or should we dive into the next topic? What do you guys think here?
Marcel, I think it's a fantastic idea. Of course, this this is not a dictatorship, but a democracy. But I think now's a great time, right? Because we're wrapping up how to get started in multifamily, and to be able to just have a time where everything can be synthesized and folks review it and come with questions, I think would be fantastic.
Okay.
Yeah, I agree. I think just have that Q&A session, and then I think the following week I don't know if we're going to be able to do a Zoom because we'll be at the Grant Cardone event in Miami. So we come back and then we can discuss that GPLP structure that I think we were talking about doing at one point. That might be a good idea.
Yeah, sounds good. One step at a time, and then get you guys' feedback too. Throw that. I see some questions about run through a deal. We can do certainly something like that too, and throw that into the Facebook group, guys, as well, right? I mean, wherever you feel like it's something that you guys would like to dive into, throw that in there. But I think we're all aligned here. If we just do like a simple Q&A, specifically, obviously through like how to get started in multifamily real estate. And then if we go into the numbers, we can divert back, to any kind of slides that need to be reviewed. Yeah, amazing. Then let's conclude this, guys. And let's give some feedback to Victor here, guys. Who here believes he's a doctor? Actually, I don't believe him anymore. I feel like he might be a how do you call it, mathematician or something like that, or like an investment advisor, or a far distinct from Albert Einstein. I mean, I mean, look, I mean, I learn a lot just by watching Victor do this. I mean, this is absolutely incredible. And the best part of it is, guys, and I don't want to go over here, but I need to say this. When we started this 101, I started introducing Victor into the topic with like, you guys are going to be amazed, and he's like such an underwriting ninja and genius and yada yada. And he was like, yeah, no, I'm not. I just, I learn a little bit here and then. I'm just okay. And I said, after the Zoom, I'm going to ask everybody's opinion, about that comment again. And I would like to ask everybody that again, now that we finished 301, what do you guys think is the value that Victor has provided here, and just his skill set about the content on one end, but most importantly, the second thing is that he can translate and teach it, in an extremely understandable way. That I think is the big part here, because everyone can find stuff on YouTube, you know, or on Google, but just to understand it, you know, to really put it on a very base level and is a different story, right? See, Victor, so I hope that's clear now. To see it all in the chats. I love
Thanks
it.
for those words, guys.
I love it. All right, then we'll come back, guys, with the Q&A next week. Make sure post your homeworks in the group, right? Let's be active in the group. Let's also be known, be a leader, help others. Let's collaborate in the group. Everything, and huddle up there. Any feedback from you guys, Charles, Victor, Trevor, before we go to the last slide here?
Man, just want to give mad props to Victor. Yeah, I mean, we all know how busy he's been with his 9-to-5 job, taking care of his sick kids, taking care of his spouse, and he's putting in the extra hours, of course, to not only support our team, but the community as well, especially logging in the hours to put together these slides and prep for, you know, the 3 sessions that he's done a lot of heavy lifting in. So, Victor, thank you so much, brother.
Exactly.
Do you mind me asking what the Grant Cardone event is you guys are all going to?
So that's going to be the real estate summit in Aventura, Florida. That's going to be the 15th through the 18th.
Thank you.
Yeah, whoever is there and whoever is in Florida, right? Let us know. Let's huddle up. We're gonna be. There's 2 events that we'll be part of with our mentor Carlos Salguero in the evenings. If you guys are not joining the summit, you know there's events in the evenings. Anybody that's close in Florida, I encourage you guys come down Friday night, Saturday night. Put it in the Facebook group or huddle up with us offline during through Messenger, and we'll get together.
The 19th is what I've got.
Yeah, awesome. All right, I'm gonna try to share my screen here and let us go with how we always do, but I still haven't paid my internet bill, so let's see if this is gonna crash again. I guess over the last few weeks. If it does, then Victor, Trevor, or Charles, please take over. Okay, I think Victor, you have it too. So let's see what happens here. Yeah, bear with me. I think we're still good to go. So, guys, then let's freaking crush it this week. Be active, get known, and we see each other again next Sunday for the Q&A. And man, I'm just overall excited. Keep growing this community. Let's all crush it together. Peace out. Thanks for joining. And let's freaking go.
Hey, yeah. All I do is win, 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 no matter what. Got money on my mind, I can never get enough. And every time I step up in the building, everybody hands go up. And they stay there, and they say yeah, and they stay there. Cause all I do is win, win, win. And if you going in, put your hands in the air, make them stay there.
Ludacris going in on the verse, cause I never been defeated and I won't stop now. Keep your hands up, get them in the sky for the homies that ain't making it, my folks locked down. I never went nowhere, what they saying Luda's back. Blame it on that contour, the hood call it Luda yak. And I'm on this foolish track, so I spit my foolish flow. My hands go up and down, like strippers' booties go. My verses still be serving, tight like a million virgins. Last time on a college remix, now I'm on the original version. Can't never count me out, y'all better count me in. Got 20 bank accounts, accountants count me in. Make millions every year, the South's champion. Cause all I do is win, 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 no matter what.
Got money on my mind, I can never get enough. And every time I step up in the building, everybody hands go up. And they stay there, and they say yeah, and they stay there. Cause all I do is win, win, win. And if you going in, put your hands in the air, make them stay there. Swerving in my low, head on